Hello and welcome subscribers to the Saturday Summary for June 28th of 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig, Executive Sales Consultant for Brokers Alliance. This week was full of warning bells for the economy and ultimately equity markets. The big news was the final revision of the first quarter U.S. GDP to a negative 2.9%, which had ramifications across markets throughout the globe. We'll talk more about that later. Now, the second quarter ends on Monday. If ultimately GDP for the second quarter comes in negative, that is officially a recession, but we won't know those numbers until well into the third quarter. Now, this week was dismal for economic news. In addition to the GDP revision, U.S. consumer consumption in May was far less than anticipated. Non-energy manufacturing continued to decline, and U.S. inflation hit a level that is now causing concerns, and the dollar fell against the Japanese yen. This is a warning sign we'll discuss later in the summary. Similarly, geopolitical risk did not improve, with the Iraq situation deteriorating rapidly and the Ukrainian-Russian dispute also deteriorating. Now, most of the broad indexes were flat this week, with the exception of the NASDAQ, which posted a 0.68% gain. Calendar year-to-date performance of the broad indexes did not change significantly. Now, as become common in the past weeks, another odd thing happened in the markets on Friday before the close. As we see here on this chart that tracks high-speed trading, at 3:50 p.m., that is 10 minutes before the market closes, 143 individual stocks suddenly had price movements of at least 2%, some over 10%. In a period of about 27 seconds. And a total of 678 individual stocks had a price movement in that time period of about 0.5%. Now, on this chart, each line represents a single stock. Now, even in this era of high-frequency trading by computers, this was very unusual. Market watchers really had no explanation for it as of press time for the summary, other than it was not related to the annual reconstitution of the Russell 2000 index, which occurred in the final seconds of trading, as was predictable. Well, regardless of the reason for this is a great visual explanation of how fast markets can fall when high-speed computers are doing 70% or more of the trading. Thanks to Nanex and Zero Hedge for this chart. Now, what's this about the Russell 2000 index? The index changes the individual component stocks that are represented in the index annually, and this is well known in advance. Like all indexes, the stocks that are represented in the index is based upon a variety of factors, but most notably is that the Russell 2000 is an index of what we call small cap companies. Therefore, each year, the market value of the companies in the index is examined, and if they are no longer fit the small cap definition, then they're removed from the index. Well, the flurry of activity seen in the last few seconds in the market at this chart represents funds that mimic the Russell 2000 index, buying and selling stocks to come in alignment with that reconstituted index. Well, our headline in the summary this week is warning signs, and there are several very important ones. First, the president of the St. Louis Federal Reserve Bank, James Bullard, in statements he made this week, telegraphed that the Federal Reserve may be getting to increase interest rates sooner than the markets expect. This is due to rising employment and rising inflation. Now, his statements briefly caused the markets to drop, but not significantly. Remember, if the Fed raises interest rates by adjusting the federal funds rate above the 0.25% it's been at for years, this will cause equity markets to decline. Well, it seems the Fed is trying to get the word out and slowly deflate the stock bubble they've created, but no one believes it. It's sort of like a junkie's heroin dealer threatening to reduce the supply they've been providing for free for years. Next up in the warning signs, corporate profitability declined substantially in the first quarter. U.S. corporate profits were 8.8% of U.S. GDP, down from the over 10% of GDP in the final quarter of 2013. Now, to quote the article on page 6, the long-term average for this is 6.3% of GDP, according to the government's data. Unless corporate profitability has reached some kind of a permanently high plateau, the recent drop is just the beginning of a much bigger decline. Again, you can read that article in the written summary. Next warning sign, junk bond yields are near record lows. This is an indicator of a coming market decline. To quote the article on page 12 by David Stockman, note that before each cyclical peak of the S&P 500, that junk bond yields plunged into new cyclical lows. Next warning sign, the Japanese yen significantly rose in value relative to the US dollar. Now this has major implications for US and global equity markets. One of the driving factors in this bull market has been what is called the yen carry trade. In a nutshell, big market players like hedge funds borrow money in Japanese yen at next to zero interest. They then convert those yen into US dollars and use those dollars to buy securities. There has been a direct correlation between the relative value of the yen and the US dollar and the rise in the S&P 500 for some time. Well, this week, as the negative US GDP was announced, the yen futures market became so chaotic that trading was actually halted. Bank of America Merrill Lynch issued a warning that a breakdown in the yen-US dollar relative value is forthcoming. Now, if this occurs, expect a lot of big traders to have to sell equities and their leveraged positions suddenly have to be liquidated. Next, warning sign, corporate stock buybacks announcements have dropped significantly. Now, corporations buying their own stock has again been one of the major drivers of the bull market, because this not only drives up the price of stock, but also increases the earnings per share ratio. To quote the article about this on page 7, the sharp slowdown in buybacks is a negative sign for the US stock market. Share repurchases are the main way companies reduce the float of shares. Perhaps fewer companies don't like what they see when they look into the future. Now, if you're within a few years of retirement, listen to these warning signs. This editor is often accused of being anti-stock markets, but that's not true at all. As stated previously, we at the Saturday Summary are pro-balance. We think retirees and those nearing retirement should have a significant amount of their retirement savings in financial tools that provide guarantees against loss and guaranteed retirement income. This provides the retiree and the near retiree with the safety net to strive for larger gains in the markets. Now, this editor has long held and long stated to middle market clientele that there is nothing wrong with having money in the markets as long as you understand that you are not driving. Markets rise and fall largely based upon the actions of large institutional investors and of course central bankers. They are in the driver's seat, you're simply along for the ride. Simply put, in the first phase of a bull market following a crash, it is the big investors who stay in the markets, and they're driving the markets back up. They do this with leverage strategies like that yen carry trade that allows them to take advantage of interest rate policies, corporate stock buybacks, and other complex trading methods. Now, as the markets increase, the retail investor, that's mom and pop, jump into the market so they don't miss out on all the big gains. After all, they need to retire someday, and they're lured by media reports of record highs. So they are now in the car and along for the ride, but the car is still being driven by these big investors. Now, as the top of the market approaches, the big institutional investors, because they have access to information, recognize the signs of a market top and they start to get out of the market. Now, we've been seeing this since the beginning of 2014 as institutional investors have been what we call net sellers of equities. These big investors also begin to prepare their parachutes at this point by buying put options or bets that the markets will fall. Finally, as the markets turn negative, the big investors that were driving this upward trend are no longer in the car, leaving mom and pop to incur losses. Well, you don't have to go over this cliff. If you are within a few years of retiring or already retired, jump out of the car and take advantage of financial tools that will guarantee your retirement income no matter what the markets do. Do not wait until your gains and savings are already going over the cliff. Well, that's your Saturday Summary for Saturday, June 28th of 2014. Have a great weekend. We'll see you next Saturday.